With the election now a week behind us, we have digested the results and we want to share our high-level take on what's to come and how we're navigating the markets. It's important to remember that the underlying economy is more important to the market than the makeup of Washington. Since 1977, the S&P 500 has averaged 16.46% during the first year after a presidential election, regardless of party. The only negative years were during the Great Inflation period, 1977 under Carter and 1981 under Reagan, and then in 2001 under Bush after the dot-com bubble. Both of these were periods of great economic stress. If we exclude these 3 years, the S&P has averaged 18.46%. We believe the economy remains strong, with fourth quarter GDP expected to grow by 2.4%, a healthy consumer, and positive corporate earnings surprises across 75% of the S&P 500 companies that have reported Q3 earnings. And let's not forget, we are in a rate-cutting cycle. All of this bodes very well for long-term investors with a domestic focus. Following the 50 basis point rate cut in September, the Fed cut rates by another 25 basis points last Thursday, and the markets are forecasting another rate cut in December. What we heard from Fed Chair Jerome Powell is that election results will not have an impact on short-term views, which provides a stable backdrop for investors.
So where do we go from here? The challenge is to split out what President-elect Donald Trump really plans to do from what was merely campaign rhetoric. I'll outline several key policy areas and expectations next. Fiscal policy. The Tax Cuts and Jobs Act is scheduled to sunset in 2026, but we expect an extension of the bill and the 37% top tax rate to remain. Trump floated dropping the corporate rate from 21% to 15%. He also pledged no tax on tips, overtime pay, or Social Security benefits. But can he do it? Tax-free tips could be the most feasible, as it has a smaller deficit impact at an estimated $300 billion over a decade, compared with more than $1 trillion each for making overtime pay or Social Security benefits tax-free. That said, it will require the approval of Congress, which will already be looking for ways to reduce the deficit if the Tax Cuts and Jobs Act is extended. Tariffs. Tariffs have been promised to the tune of 10 to 20% on all imports and 60% on Chinese imports. We see these as negotiation tactics. Wide-ranging tariffs on U.S. trading partners could lead to tensions with long-standing allies and spike concern for an uptick in inflation. Immigration. Mass deportation seems unlikely given the essential role of immigrant labor in the U.S. economy, plus legal challenges, high funding costs, opposition from blue states, and lack of a process to deport. Deregulation. Proposals to reduce regulations, particularly in mergers in the energy sector, could boost growth and support business sentiment. The economy should benefit from less regulation, weaker Department of Justice and Federal Trade Commission involvement, and increased merger and acquisition activity.
The election outcome has spurred a reflation trade, with U.S. equities, bond yields, crypto, and the dollar rising all in tandem. Looking forward, we remain constructive on U.S. growth and maintain an overweight to U.S. equities, which are well positioned within a strong macroeconomic backdrop of stable growth, cooling inflation, and synchronized global monetary easing. Corporate tax cuts almost automatically boost stocks. Tariffs almost automatically mean a stronger currency. Bigger deficits mean higher bond yields, and easier regulation helps bank stocks, among others. So far, equities have been able to digest the increase in bond yields relatively well, and we expect this to continue as long as the growth and inflation outlook remain friendly.
The obvious question is then, how far can this trade run? It's a tug of war between rates and reflationary optimism. What we've seen is when the 10-year Treasury yield goes up by more than 2 standard deviations from its trough over a 3-month period, that usually weighs on equities. But with the presidential uncertainty resolved, markets are likely to shift focus back to corporate earnings, which have been stronger than expected. We continue to prioritize companies with strong balance sheets, resilient business models, and solid growth prospects. If you have questions or would like to discuss the impact of the election on your financial situation, please reach out to your advisor or the Evans May Wealth team. Thank you and have a good week.